Welcome to the 3 Edge Week in Review for the week of April 29th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing what has been an ongoing bear market in bonds, and we'll discuss if there might be better alternatives available for investors seeking an asset class with which to hedge against their equity holdings. So let's get started. Let me bring Steve into the conversation here. So Steve, as we know, traditionally investors have sought to hedge their equity holdings by diversifying into bonds. They were regarded as a safe asset class. However, as we also know, they have really struggled over the past couple of years. Interest rates have risen, bond prices have declined. So maybe you could just discuss, when did this bear market in bonds actually begin, and just how bad has it been?
So the bear market in bonds began in July 2020, and using 10-year Treasury as an example, it's actually been the worst bear market in bonds in the history of the U.S. I know that's an extraordinary statement. People are well aware of the bear market in bonds in the 1970s, and then again in the 1940s. But in the 1970s, we had an extraordinarily bad bear market in bonds. This is worse. If you're an investor in 10-year Treasuries, starting when the bear market started, even including interest income, you lost over 21% of your money, the value of your bond, even when you add interest in. And if you had a longer duration bond, it was even worse. And it's so curious how little press this has been given. And it's even more curious that so many investors are still thinking of bonds for their safest part of their money.
Absolutely. So, as you said, traditionally investors think of investments as bonds as being among the safest, right, in their portfolio. But why might this no longer be the case?
Well, I think so many investors, whether private investors or professional investors, learned how to invest or learned how to develop their investment approach during a period that was extremely abnormal. We had the greatest bull market in bonds from September of 1981 to July 2020, the steepest drop in interest rates over a period like that ever in history. And yet, it lasted so long that people thought that was the normal. And so in a period when interest rates and inflation decline that rapidly over time, bonds have a big tailwind because not only do you get interest income, but you get the principal value of your bonds appreciating all during that period. So it makes bonds look like a great part of a portfolio, and they're quite safe because even if there's some volatility, you're either getting a high interest income or as rates keep coming down, you're getting principal appreciation. Well, those days are over. Now, before 1981, before September of 81, we had 40 years of a terrible bear market in bonds, but so many people either didn't experience that or didn't read their history books or didn't learn about that period. And unfortunately, when rates bottomed out at 0.5% in the 10-year Treasury in July of 2020, that was a big sign, a big red flag saying, this is so overdone, that this bull market in bonds is so beyond normal that it's got to reverse at some point. And in reverse, it did. And that's why we're now in the biggest bear market in bonds. So what we have is a situation also where some investors will say, well, I'm not worried about bonds not being safe because as long as I hold to maturity, I'll get my money back. But that ignores a very, very important investment principle, and that is over the duration of a bond, and it could be 10 years, it could be longer, the money you put in is worth so much more than the money you get back at maturity because of the time value of money. And on top of that, if there was much inflation during that period, that money you get back is even worth less relative to inflation. So that is quite a myth. And especially if you don't hold to maturity, but you need to sell the bond somewhere in that period, you will get immediately hit with the loss of principal if interest rates have been climbing.
Excellent. All right. So my last question, for investors who want a portion of their portfolio invested for safety, as for example, a hedge against their equity holdings, what are some of the alternatives to investing in bonds?
Now that we're no longer in that great bull market of bonds that existed before July of 2020, it's really important to look at other alternatives. I want to turn to the seasons of the market chart, a chart we've seen before, and I'm sure we'll see again. And it describes how the market goes through different phases, and at each phase, different asset classes outperform. And in the so-called winter season, when we're in a deflationary or disinflationary recession, bonds can be a good hedge and do well. But in all the other phases, bonds are not your best hedge. For instance, like what we have now, we're in an overheated economy. We have very low unemployment. We've had inflation above target. Bonds do very poorly in a period like that, and certainly they're doing poorly now. And in that period, real assets or hard assets are a much better hedge than bonds. Next, often the Fed leaves interest rates too high for too long. They over-tighten because of the lags in the monetary policy and as they affect the economy. And then we get into a credit contraction. And that's when very short-term treasuries or cash are much better hedge and do very well. And even if we get into winter in a recession, if it's stagflation, then bonds still won't be your friend. They still won't be a good hedge. Now, sometimes it's easy to predict what phase we're in, but even in those cases, it's hard to predict when we're going to move into another phase. So we recommend a diversified approach that includes all these different assets and to try your best to minimize drawdown. And so we've constructed a portfolio we call conservative, and that has multiple types of assets with very thoughtful ranges around each asset class. I'm going to show you another chart. This is going to show the performance of this multi-asset fund we call conservative relative to both the bond index, the aggregate bond index, and very importantly, municipal bonds. A lot of people think municipal bonds are a great safe place to be. You get some tax advantages. But even after tax, we've outperformed both of those bond indices since inception. And even when we were still in a bull market in bonds, we did well against those indices. Next, I want to show the chart that does show since the start of the bear market in bonds. You can really see that widening. Once the bear market started, we really separated in terms of performance and continued to show safer volatility and safer drawdown.
Great, Steve. Thanks for your insight on this important topic, particularly since investors may not be aware of just how much bonds have struggled in the past few years, and for pointing out some alternatives other than investments in traditional bonds to hedge against equity market risk. So that will do it for Steve and me for this week. I will be back next week with Eric Beagleisen, Director of Research and Deputy Chief Investment Officer here at 3Edge, for our monthly view from the Edge. And Eric will discuss our most recent outlook for the global capital markets and how our outlook may have changed from the prior month. As a reminder, all our videos are always available on our 3Edge YouTube channel. And if you think you know someone who might benefit and enjoy watching the videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.